It's Wednesday, which means it's time for a first look, and today we're taking a look at Gearbox Protocol. It's decentralized leverage, it's composable, and it's all about capital efficiency. Coming up after this message from our sponsors. Scam wicks, insider order books, cascading liquidations. Suffer these compromises no longer when trading crypto futures. Enter GMX, a futures and swaps dex with low swap fees and zero price impact trades. Aggregated high-quality price feeds provide fair liquidations and pricing. GMX is available on Arbitrum and now Avalanche. Trade BTC, ETH, AvaX, and more securely from your wallet with up to 30 times leverage. GMX is mobile and desktop native, including limit orders and stop losses. Visit gmx.io today to start trading, learn about high-yield opportunities, and discover the Blueberry community. So Gearbox Protocol, here's the sales pitch. Get up to 10x leverage and use it across DeFi protocols. It says Curve here, but it could be Uniswap, it could be Yearn. So here's how it works. You're probably familiar with the concept of leverage. You can go onto a centralized exchange and get leverage to trade on margin. So far, so good. There are also other ways to get leverage in DeFi, also absolutely fine. That leverage is very much platform or protocol specific. What Gearbox does is it says, let's take that leverage piece and build our own specific set of contracts that will manage the relationship between those who provide the liquidity, which is the lenders, and those who borrow it, and wrap that all up in something that can then be taken and used elsewhere. So we do leverage, and we do it really, really well. But then if you are in need of leverage and you're someone who wants to take advantage of that, then you can go and use it on a small but effective list of protocols to interact with. We'll get into who those are in a bit. But equally, you could be a protocol that really wants to add a leverage component to your protocol. This is how you would do it. You can bolt that module onto what you're already offering, and then suddenly you have a leverage component. And it could all happen under the hood, and you could skin it the way you wanted to with your own UX. So there are two sides to this. There are lenders. These are liquidity providers who seek additional yield and have a higher risk tolerance. Oh, yeah. So this is like providing liquidity on Compound and getting C tokens back instead. So those assets that you supply are then used by those who are looking to trade on leverage elsewhere. And pretty much anyone can be a liquidity provider on Gearbox. You don't get C tokens, you get D tokens. Diesel. It's kind of fun. The borrowers, there'll be traders or farmers who wish to increase their position by borrowing liquidity from the protocol at multiples of their collateral for which they pay interest rates. It's very, very familiar with this. The liquidity they borrow is 4x plus or more of what their notional size is, and this is the leverage they get. It's important to think about this leverage not as taking on debt or playing the casino. It's about capital efficiency. You have a certain amount of funds. Those funds can do more for you if you know how to manage the risk properly. And it's not like you have to be extremely risky with all this. You can take the collateral, convert it to stable coins, and then go and use that on something like Yearn. So you're kind of safe there to a degree. I mean, there are obviously risks. There are always risks. But in that sense, you're not going crazy on margin and going crazy on liquidation risk. So how does it work? You have the borrower's funds, so they've given this example of 25 ETH, and then the liquidity providers will then give you 75 ETH if you go for a X3 leverage. That means that your total will be 100 ETH, and that sits in what's called a credit account. Now, the credit account holds users and borrowed funds. It has liquidation thresholds. It has a list of allowed tokens and protocols it can interact with. And then all the operations go through this account and all assets remain here. It reminds me a little bit of the Visor vaults we looked at last year. But this is an architecture that allows the leverage to remain ring-fenced and only interactable with protocols here, Ava 1inch, for instance, that have been approved by the DAO, and the DAO governs what can be connected to that smart contract credit account. So you can see here that the borrower put in 25 ETH, borrowed 75 ETH, and then in total they have 100 ETH to go and play with on these specific protocols. So the key features of all of this, it's devolving this idea of leverage and making it composable. So you can take your leverage with you wherever you're allowed to go. And I think that this is going to grow quite quickly, but it's being managed by the DAO at this stage. It's decentralized, you fully control your funds, and it's fully transparent, so you can always see what's going on at any time. It's composable. Now, here's the interesting thing. There's no order book or trading environment within Gearbox. So all it's really doing is saying, here are some people who are willing to put up liquidity. Those are the lenders. And then here's you that's wanting to get into an arrangement with these liquidity providers to go and do more with your capital. There's no funding rate because it's not based on synthetic positions, but with real assets. And then obviously this idea of leverage as a service, allowing other protocols to add out of the box leverage solution. And then there's some very clever stuff to do with low gas overhead. So users each have their own credit account. So instead of executing trades via a giant pool of liquidity, it uses the virtual balance of each user. And that basically means, long story short, that it's quite gas efficient. I wouldn't say it's massively gas efficient, but it's a lot more gas efficient than you might think for something that's doing this. So just to come back to this credit account, when you actually go and trade on other platforms using this credit account, it's the credit account that's interacting with them. So you might have you'd be used to using MetaMask and then seeing the funds in your MetaMask wallet. That's not what's going on here. The credit account is what's interacting with those protocols. You can sign a transaction using MetaMask, but it won't be MetaMask itself. So it's a slightly different way of thinking about things, and the smart contract permissions apply within that. So here are some use cases that they say were never possible before. Well, I don't think they were. This is true. So this is a yield generating 5x short ETH or 5x long ETH. So you can see how it works here. The trader puts in 25 ETH worth of funds, and in this instance, they're actually doing a 4x leverage. So they come out with an ETH balance of 125 ETH. And in this scenario, they swap those to stables and then deposit those stable coins on yen. So the asset value in stables is secure, and then they're earning this 4.24% APY on their stables. Now, 4.24% doesn't probably sound that exciting, but they're outperforming the debt interest that they would be paying on that 100 ETH. And of course, they can go and look for better opportunities or riskier opportunities if they want to. But here's a way that they could make that 4.24% go further because they're 4x leveraged. So here's the allow list. You got Curve, you got Uniswap V2 and V3, Yearn Finance YUSDC, Yearn Finance YDAI, and SushiSwap. Now these allowed contracts are voted on by the DAO. It's an established and blue chip protocols list at the moment, and it's sure to grow. So obviously you're using leverage here, so there is a risk of liquidation. So your credit account is your collateral. It includes the initial funds plus the borrowed amount, as we saw previously. Gearbox, the protocol, can see what is going on with your credit account's value at all times. It can see what interactions and what positions you have in what DeFi protocols. And it basically gives you a score, a health value, which will be liquidatable if it goes below 1. So here's the formula for that health value. Honestly, I didn't really understand how it comes together, but you can probably work it out. The documentation around Gearbox it's pretty good. So anything that it goes below 1 is liquidatable. So you want to keep it up here. And anyone can run a liquidation bot. So if liquidations are your jam, then grab a big spoon and add a bot to it. Managing health on Gearbox, well, basically you get this health factor, 1.28 here. That's okay. It's not great. You want it to be green. If you're getting into a position where you're at risk of liquidation because things have gone against you, then you can top up your collateral or you can close your account to avoid too bad of a liquidation. Supplying liquidity is pretty simple. You supply liquidity in the asset you choose, and at the moment it looks like wrapped ETH, wrapped BTC, USDC, and DAI. And then when you supply capital to a pool, you get these diesel tokens, which function like compound tokens. So these are the protocol representations of your token, and that means that they accrue interest and pool fees as and when you are due them. So in terms of protocol fees, how does the protocol make money? Well, it makes money from liquidity provider fees. A withdrawal fee is taken when a liquidity provider withdraws funds from the pool, not when you put them in. So when you take them out, they take a fee. And then there's trader and farmer fees. So if a credit account is liquidated, some percentage goes to a third-party liquidator and some percentage goes to Gearbox. So the liquidator gets 5% and the protocol gets 2%. And that is it. Now, I actually happen to know one of the team members, a man by the name of Ivan Golovko, and I thought it'd be really interesting to get his perspective on what they built here and how they used the Lobster DAO to test some of the features before they went live with it. So that's what's coming up next. If that's not what you're interested in, then stop watching here, and thanks for joining us. But if it is, there's some pretty good insights in here into how it was built, how they tested it, and we'll give you more of an understanding of how this could fit into your own trading strategies in DeFi. We have Ivan Golovko on the show, and he is a man that I've known for some time. And it's rare that you get to meet people in real life and then continue to be, quote unquote, friends with them. But Ivan is now basically part of a DeFi protocol, which I never thought I would see happen because he's always floated on the outside. But tell me about Gearbox and why it was that you stepped back into the ring with this one.
So as you said, I was on the outsides after we were both at the blockchain project at Layer Ones. I think we both kind of had enough of our own thing. And I was somewhat angeling and just helping founders, being friendly with them, farming, anything that is not really inside the protocol, because I was tired of it. And then I met two developers who were really passionate, and they were just doing hackathons pretty much all the time. So, like the hackathon people, the true people, like 1inch people were doing, for example, founders. It's really the guy who just constantly coding. They not even try to build the company, they just coding. And what I learned over some time is that when space like crypto especially, the best signal is not somebody trying to be too legit or having credibility. It's really the people just being hardcore passionate about just one thing, anything, right? I was in love with the idea because what I loved about it is composability. I think that's the most key word about Gearbox, composability. What I don't like about crypto is people rebuilding stuff. Why at some point I got turned off of Layer Ones, for example, I think maybe you had a similar reason. You pretty much were rebuilding the same thing that another chain had fully just by yourself, right? With the new crowd, it's not drastically different. Yes, technically something changes, but pretty much the same thing. If it's an AMM, it's an AMM on another chain, curve tweaked a bit, not much different. Anything else, grants, whatnot. Here it's about composability. So it's like, without diving into what it is just yet, composable is that it can work with other protocols. It can be integrated with pretty much anything, be in the middle of a stack, at the bottom, at the top of it.
Leverage is a bit scary for some people. What does Gearbox do that is different with leverage?
Yeah, so leverage, the way you perceive it on, let's say, Binance, FTX, or wherever else, so 25x in an altcoin as collateral, that's risky, right? But if you look at leverage in a safe perspective, meaning you can actually account for how much liquidity that to liquidate in, you can always balance out everything within your position, you end up not really with leverage, but with capital efficiency. For example, let's say, Robin, you own 2 houses in Amsterdam because we all know you're rich. And then if you just own them and you pay taxes on them and you pay utility bills, you're not actually using the potential of it, right? The economic system's finances are somehow built in a way where you should kind of max it out. Otherwise, you're either losing to inflation or you just not utilize it as well. And it doesn't mean you do have to be degenerate. You just utilize it properly. So, for example, in your case with 2 houses, you would pretty much just take a loan essentially on one of them as collateral. Of course, you would need to present some income, right? So the bank knows you can actually pay the down payments. But essentially, you just get more capital efficiency, and then you can go invest in stocks or buy something new for your children, or even just get something to invest in with. Does that sound like leverage to you? Not really, right? It's not degenerate 100x. It's just more capital efficient. You have more resources, you can utilize them in one way or another. In a way, if you were to put Y-earn LP tokens into Abracadabra with a safe liquidation threshold, is that degeneracy or is that just capital efficiency?
So why don't you talk us through what Gearbox is about and sort of how it works? This is your elevator pitch moment.
Oh God, I'm so bad at those. Okay, so now actually, without being too euphoric about it, some more specifics. Gearbox is a composable or generalized leverage protocol. Why composable? Because it can be integrated with many different things, and I can explain about it in a second. And generalized because it's a general purpose. So it's a bunch of other things you can do with it, not just 100x a coin. So borrowers can come in, and right now in lending protocols, you can only take less than the collateral you post, right? Because otherwise it's under collateralized lending, and then you end up with some KYC and other TradFi kind of. So far, it's not really working out that well. It has some traction, but it's a really different thing. But okay, you as a borrower, you come in, you put 5 Ethereum of your own money, and you borrow, let's say, 4x from the pools. Now you have 20 Ethereum in your account that you can operate. So you have larger notional capital than you have. Instead of 5 ETH, you have 20 ETH. Your immediate question, okay, if I just give you the money from the pools, right? Why don't you just run away with it, right? Why didn't you like borrow and run away? This is where the architecture comes in. The money that you borrow and your own capital, those two, they end up in what is called a credit account. A credit account is just a smart contract. Every user has their own. So you can imagine hundreds or thousands of those credit accounts. And that's your entire position. It technically belongs to the protocol, but you operate it. So you cannot take money from it, but you can tell the credit account to go trade on Uniswap or farm on Curve or swap some other assets or whatever it is that is within the allowed list policy. And that is what assets you can interact with and what contracts you can interact with. So then this is the prevention policy against something going, against you taking the capital out. That's why people said, okay, this is actually similar to prime brokerage. Since you take leverage at the bottom layer, right? And then you just go swap altcoins on Uniswap, and then you put that money into Iron, and then you do something with Compound and with Aave. So essentially it could replace a normal MetaMask account, which only has 5 ETH on it, because now you can operate something with 20 ETH in it.
You were one of the most kind of skeptical people and one of the rare contrarian voices, just saying this is bullshit when stuff was bullshit. Are you still doing that, or have you shut up now?
I think I've mostly shut up because at some point the bull market makes you shut up, right? You cannot scream this is retarded for too long. Because even if it is, it's more like, there is a very thin and understandable line of a founder, or let's say a group of people, right? They presumably say, oh, let's take an example recent. They say they're doing P2E gaming. You look at them, you're like, you don't really have experience with gaming, or they made a game which had like 5,000 installed, right? Not that much, so you cannot say they really have experience. The easiest way is to shit on something, right? You're like, okay, guys, you don't have the experience for that. You're not worth 500 million or whatever the valuations are these days. It would be kind of correct to say. But then it turns out they can actually make something successful. They end up building a guild next to it, something else. And now they're actually, I don't know, even using the capital to help fund public goods and do something genuine. So by shitting on them early on, you are a moron. You weren't wrong, but you're still a moron. So it's more like you rather bet on the positive side of humanity rather than being on the negative side and being too conservative. But what many people end up doing, or let's say not really seeing, is that quite often it goes wrong, where you just end up betting on every scam there is. And what is the thin line between the two? It's very subjective, right? We all have our own differences, reasons, ethics. Something that's ethical to you might be unethical to me. Maybe just shutting the fuck up sometimes is the best solution,
Yeah, you got to pick your battles. And I'm going to pick one now. I see it on the Gearbox website, Leverage 2.0. Who came up with that? Is that you? Because you can't say that stuff anymore.
No. Yeah, the 2.0 thing went kind of wrong, right? It's really went the full circle back.
Have we earned the right to call anything version 2 yet? I mean, we're still like 0.0 something.
We're at blockchain 3.0. People have been pitching layer 3 since half a year ago, so I think it's okay being 2.0 these days.
Always fun talking to you, but I'm just curious what is coming up for Gearbox. What's oh god, I'm going to say it. What's your roadmap?
Anyway, chill. There was a roadmap. What's coming next? So Protocol launched mid-December. It's live now. They have been like only 100 accounts or something because the TVL limits were put in place, which are very, very low. And the limits on how much you can borrow are very low. So it's test and prod. We just wanted to see, since the DAO launch, how it behaves, what people at least click on and just test it live. So currently it's pretty much has not launched. DAO is now thinking of increasing the limits to at least 200K or something, which already makes it fine to trade with leverage into assets and maybe positions on mainnet. So your profit will, of course, make up for the gas costs at that point. So that's good. And also we have a new audit upcoming. It's going to be audit number 5. So we are doing many of them because security can never be a small issue. That starts end of February, should be done by end of April. So around beginning of April, let's say mid-March, is when you should probably really start looking at it because then new adapters will be added. I can just show something in advance. Imagine leverage farming in Convex. So instead of getting the 5% AVY, you can be getting like 4x of that. Pretty good, right? I would honestly use that. I would genuinely go and use that. Or leverage stake in Lido. You can let's say you like stake in ETH on Lido, right? Because I don't know, because you do. You just don't want to trade out of ETH. You can do leverage staking now. Well, soon. So a bunch of stuff upcoming. I think give it another month. The community and the DAO have been absolutely amazing. Like the response has been very welcoming. Andre was very how they call it, doomsday about it. He's like, as soon as you launch something goes live, people will kill you, shit on you, or something like that. And so far it has been quite nice because the token has been not transferable. Maybe as soon as that changes, I will have to hire security guards. But yeah, and a month from now, more news, limits going up, and should be much more functionality and composability. What you see now is like 1% of what can be, because right now it's literally just a testnet but on mainnet.
Listen, Ivan, it's always a pleasure to talk to you. We should wrap it up there. I think this is cool. I like what you've built. I genuinely do. And I'm curious to try it out for myself. Hopefully we'll pick it up again in March when there's actually something we can do.
And then we can actually click on the interface with the should be new and crispy. So yeah, I would love to. Thank you.
I know. Well, I don't envy you. There's you never sleep. There's always things to do, and there's always improvements to be made, and then there's always a bunch of people that hate you. So it's fun times, good exposure.
It's the circle of life. That's right.
It is this. It's the circle jerk of life. So that's it for First Look this week. I hope you enjoyed the chat with Ivan and a look at basically this interesting way of separating out leverage and turning it into its own system that can be then composable. I think it's a pretty interesting idea. We probably will see this being kind of bolted on, and we'll probably see more and more of these types of very specialized DeFi primitives that can be then used across other bigger platforms. Definitely going to be seeing more downside protection, for instance, bundled this way. So really, really interesting. If you have any suggestions for us to cover in First Look, please do drop them in the comments below. And as always, get subscribed, get liked, just get woke or something. I'll see you on the next one. Peace.